Good morning, afternoon, or evening, depending on where you are. I have the great pleasure of introducing our seminar today. The research seminars in finance, economics, and banking are a joint organization by the FEBRN, a network of 25 universities worldwide, and the Financial Management Association International. We are very pleased to have with us today Professor Marco Pagano, presenting his research on climate risk, bank lending, and monetary policy. If you have questions or comments for Professor Pagano, please use the chat Q&A box, which is located below on your screen. We'll pass the questions at the end of Professor Pagano's presentation and as time allows. The research seminar moderator is Professor Miloš Božović, a colleague and friend from a long time from the University of Belgrade, Faculty of Economics and Business. The Faculty of Economics and Business and the University of Belgrade is a FEBRN partner university. Without further ado, I pass it on to you, Miloš.
Thanks a lot, Cesario. It is my great pleasure to introduce today's speaker, Professor Marco Pagano. Professor Pagano is a professor of finance at the Department of Economics and Statistics of the University of Naples, Federico II. His research is in the areas of banking, corporate finance, market microstructure, law and finance, microfinance, and currently focuses mostly on issues at the interface between labor and finance. Professor Pagano has published in many renowned journals such as American Economic Review, Review of Economic Studies, Quarterly Journal of Economics, Journal of Finance, Review of Financial Studies, and many more. According to Google Scholar, he has over 43,000 citations so far, and he was the co-managing editor of the Review of Finance. His research, amongst other things, has been supported by the ERC Advanced Grant for a project on finance and labor, and in the past 5 years, he coordinated the Naples PhD in economics. He currently directs the Center for Studies in Economics and Finance and chairs the Scientific Council of the Swiss Finance Institute and the Scientific Committee of the UniCredit Foundation. Without further ado, Professor Pagano, thank you for accepting our invitation, and we look forward to your presentation. The virtual floor is yours.
Thank you. Thank you very much, Cesario and Miloš, for this for the invitation, first of all, and for this very kind introduction. So let me now share my screen. Okay, can you all see the screen? My slides?
Yeah, it's fine.
Okay, very good. Okay, so the paper I'm presenting today is joint work with Carlo Altavilla and Miguel Busigna from the ECB and Andrea Polo from Lewis University. And since two of the authors come from the ECB, the usual disclaimer applies. The paper essentially asks two questions. One is a question on which we already have some previous evidence, and the other is a question on which no previous evidence, at least as far as I know, is available. The questions are the following. The first one is, do banks price firms' climate risk over and above credit risk when they grant loans? So do they actually charge, for instance, a higher interest rates, other things being equal, over and above credit risk for firms that they perceive to be riskier from a climate risk viewpoint. And this could be the case if the measures of credit risk that banks use from internal risk models do not fully account for climate risk, or if banks internalize social attitudes regarding climate risk. We ask two sub-questions of this question. First is, when they assess climate risk, do banks take into account also the plans that firms have to reduce emissions in the future? So do they have this kind of forward-looking view of climate risk, not only thinking of the current amount of credit risk of a company, but also how this its exposure to climate risk is going to change in the future. And second sub-question, do banks differ in the extent to which they price climate risk based on their commitment to environmental protection? So is there heterogeneity in the extent to which they price climate risk? The second question that we address in the paper is whether monetary policy, in particular monetary policy shocks, affect banks' pricing of climate risk. And if so, how does monetary policy change banks' pricing of climate risk? And here, in principle, we have two alternative views with opposite predictions. One is a view based on the risk-taking channel. In general, the risk-taking channel of monetary policy states that the monetary tightening discourages banks' risk-taking in the sense that it tightens credit conditions relatively more for riskier banks. Now, this could apply in principle also to banks that have greater exposure to climate risk. So, does monetary tightening in particular discourage banks' risk-taking of climate risk? So the extent to which banks are pricing climate risk. For instance, a restrictive monetary policy, does restrictive monetary policy prompt banks to raise interest rates relatively more to firms that are more exposed to climate risk? An opposite view is that based on financial frictions. The financial frictions view of monetary policy states that firms that are subject to more severe financial constraints are more affected by monetary policy shocks. For instance, a restrictive monetary policy shock should affect relatively more banks, firms that are face tighter financial constraints. Now, if low-emission firms are subject to more severe financial constraints, this would result in the predictions that a restrictive monetary policy would actually prompt banks to raise interest rates relatively more to firms less exposed to climate risk. So, just to clarify, they are opposite in the sense the risk-taking channel view of monetary policy says that the restrictive monetary policy shock should prompt banks to raise rates relatively more to brown firms, whereas the opposite, the financial friction channel view has the opposite prediction that the restrictive monetary policy should affect relatively more lending to green firms rather than brown firms. So these are the research questions that we look at, and just to give you a preview of the findings, the evidence that we look at gives a positive answer to both of these questions. So first, we find that indeed banks do price climate risk over and above climate risk, credit risk when they grant loans, in the sense that they charge higher interest rates to firms with greater carbon emissions, which we consider to be a measure of a transition risk, transition climate risk. And this is controlling for firms' probability of default as assessed by banks themselves. They also charge relatively lower rates to firms that commit to lower emissions in the future. So the banks apparently take also a forward-looking view of climate risk of firms, and not just don't base themselves only on their current emissions, but also on their commitment to lower emissions in the future. And both of these effects are relatively larger for banks that commit to decarbonization. So there is indeed heterogeneity in the extent to which different banks assess climate risk and price climate risk. As far as the second question goes, that is, does monetary policy affect banks' pricing of climate risk? Again, the answer that seems to be supported by the evidence is that indeed it does affect banks' pricing of climate risk, and the way it affects it is consistent with a climate risk-taking channel of monetary policy. So among the two views that I very quickly referred to before, it is the first one that seems to be more consistent with the evidence. So a monetary tightening appears to induce banks to increase both credit risk premia and carbon emission premia, and therefore it is relatively more penalizing for more polluting firms, for brown firms than for green firms. It's very important, however, to notice that this is not saying that restrictive monetary policy actually does not increase the cost of credit to green firms as well. Restrictive monetary policy increases the cost of credit to all firms, but its contractionary effect is not as strong for green firms as it is for brown firms. Where by green firms, I mean both firms with low emissions, relatively low emissions, and firms that commit to decarbonization relative to those that don't. So it is a comparative statement and not an absolute statement regarding the effect of monetary policy on the credit conditions that are offered to green firms and to brown firms. Okay, just to place what we find in the context of the literature, what we already know, as I mentioned already, the research on the pricing of climate risk in financial markets is pretty developed. Most of it actually has developed in the context of security pricing, security markets, where there is a substantial body of evidence that has found that both in stock markets, in option markets, and in bond markets, securities markets do price climate risk. The extent to which they do depends both on the measures used of greenness, so of the extent to which firms are or are not exposed to climate risk, and on the measures of returns. So there are some studies that actually look at expected returns, others that look at realized returns, and so on. I don't want to enter into this literature. So the findings are not homogeneous, but I would say that the weight of the evidence seems to be in the direction of saying that securities markets do price to some extent climate risk, especially transition risk. For credit markets, the evidence is less quantitative. I mean, there is less, there are fewer studies, and it is ambiguous. It is limited to the syndicated loan market. And for instance, here I'm quoting two papers. One that finds a negative result, the Bay and de Graaf, Delis and Ongena 2021 paper that finds that risk from stranded asset owned by fossil fuel firms is not priced. Whereas the paper by Ehlers and de Graaf, also from 2021, finds that after the 2015 Paris Agreement, brown firms pay a carbon premium relative to green firms. Also, there is no consensus regarding whether banks committed to environmental policies lend preferentially to low-emission firms and price their loans more cheaply to low-emission firms, to green firms. For instance, there are two studies, the one I already mentioned by Ehlers and de Graaf, and a more recent study by Giannetti and co-authors that answers this question in the negative. Whereas these other papers that I quote here, de Graaf and co-authors, 2020, and Kaspersik and Pedro, actually answer this question in the positive. So there is a certain amount of, how can I say, debate about whether, first of all, in credit markets, climate risk is priced, and whether banks which are more committed, or which present themselves as being more committed to environmental policies, actually price this risk differently. On the other question, the second question that we address in this paper, the impact of monetary policy of the pricing of climate risk, there are no previous papers, at least as far as I know. Okay, now let me say something, since this is the newer part of the paper, something more regarding the risk-taking channel of monetary policy and why this leads us to predict that monetary policy tightening is relatively more restrictive for brown firms than for green ones. So the idea of the risk-taking channel of monetary policy is that monetary policy affects banks' yield-seeking incentives, in the sense that the monetary expansion enables banks to loosen their lending standards, especially for riskier firms, whereas a monetary tightening does the opposite. It tightens lending, it induces banks to tighten their lending standards, especially for riskier firms. And this view is predicated on the existence of banks of informational issues, especially moral hazard issues, within the organization of banks, the contracts that define, that determine loan officers' efforts and their reward. So here I'm quoting two papers, the paper by Chara and Nakvi, and that by Della Riccia and Levin Markets. These are different models, but they have a common prediction that when monetary policy becomes relatively more lax, then given the presence of these agency problems within banks, banks have the incentive to take more risk. Their loan officers have the incentive to take relatively more risk and therefore to price this risk relatively less aggressively. There is also evidence for this view. For instance, the paper by Della Riccia, Levin, and Suarez of 2017 finds that US banks lower their internal risk rating of new loans when monetary policy becomes tighter, when short-term interest rate rises. The paper by Jimenez, Onguena, Pedro, and Saurina, the Econometrica paper of 2014, finds instead that, consistent with this view, that when instead the central bank actually relaxes its monetary policy, in this case it was the ECB dropping its overnight rates, then relatively less capitalized banks relax their lending standards to the riskier firms. So essentially it is the riskier firms that benefit relatively more from kind of laxer monetary policy. And Anderson and Cesar Bianchi, in a paper from 2023, find that the monetary tightening triggers a larger rise in credit spreads for high leverage firms and so for relatively riskier firms. Okay, so there is both theory and evidence in favor of this view, according to which restrictive monetary policy affects in particular the riskier firms. To the extent that brown firms are riskier because they have greater exposure to climate risk, then one can expect them, based on this risk-taking channel of monetary policy, also to be relatively more exposed to a monetary tightening. Conversely, the other view, the financial frictions view of monetary policy, predicts that monetary policy shocks should affect relatively more firms facing financial constraints. And now firms with low carbon emission, green firms, can be, according to some, can be seen as potentially more fragile, financial, or more exposed to financial constraints because they have a lower fraction of tangible assets and therefore they can offer less collateral, and also because they rely on more innovative technologies which are unfamiliar to banks, and therefore banks, being technologically conservative, as claimed by Raul Minetti in a paper from 2011, may actually be less consider these firms to be more fragile or less creditworthy, other things being equal. So combining these facts with the role of financial frictions in monetary policy, this would lead us to expect that the monetary expansion should loosen lending standards, especially for the green firms, and the monetary restrictions to tighten lending standards, especially for the green firms. So the prediction is the opposite to the previous one, and monetary policy tightening should be more restrictive for green firms than brown ones. Okay, now let me move to the evidence. And first of all, to the data that we use. We use AnaCredit data. This is a euro area credit register with harmonized data from all euro area countries. The data start in September 2018 when AnaCredit was became operative, and they go up to December, the available data up to December 2022. And we have both interest rate data and probability of default data based on internal risk models of these banks. And we limit, even though we have data essentially for all the loans issued by banks to firms in the euro area, we restrict ourselves to listed firms. And the reason is that only for listed firms we have data about emissions, emission intensities, as well as the commitment by firms to reduce future emissions. From Refinitiv, from the Refinitiv database, we have the firm level current CO2 and CO2 equivalent emissions, both scope 1 and scope 2. We do not use scope 3 data because we consider them less reliable. So these are emissions in the sense that there are 1,000 tons of CO2 per million US dollars of net revenues. And we also have a variable that measures whether firms commit to reduce future emissions. So we construct a dummy that indicates if a given firm has disclosed an emission reduction target. So apart from current emissions, whether it wants to actually reduce future emissions. Now, this commitment is credible because previous studies, in particular Carbone et al. In 2022 and Bolton and Kaspersky, find that actually these commitments by firms, these targets, announced targets, actually tend to correlate with lower subsequent emissions. We also have data regarding commitment on the other side, essentially by banks. We measure banks' commitment by identifying banks that have signed a commitment letter in the context of the Science Based Targets initiative, which promotes net zero climate targets. And this is a variable which has already been used by Kaspersky and Pedro in their 2021 paper. And then to measure monetary policy shock, we use the by now relatively standard measures of monetary policy surprises that has been developed in the European Union, actually in the euro area, by our co-author, my co-author Altavilla with other co-authors, and which is provided by the Euro Area Monetary Policy Event Study database, which essentially measures the change in policy rates in a 30-minute window around ECB press conferences, expressed on a monthly basis. And it is very similar to analogous measures which have been used by Gurkianak and co-authors, Jarosinski and Caradi, Anderson and Cesabianchi in analogous studies for the US, studies of monetary policy, effects of monetary policy surprises. So in terms of descriptive statistics, the key variable in most of our regression is the spread. So essentially the interest rate change charged by a given bank B to a given firm F at time t. This is the spread over the risk-free rate charged by the bank. So it is 1.51 on average in the data set, the standard deviation is 0.76. This is an important number to keep in mind in order to assess the magnitude of our effects. We have data about the probability of default. It is on average about 1%, but it is a very right-skewed. It has a very right-skewed distribution. As you can see, only for firms in the top decile, the probability of default is greater than the average and greater also than of course the median. The same applies to carbon emissions. On average, the carbon emissions are 0.18, but only for the top decile they are above this level. And then we have 58% of the firms actually declare that they have a target in terms of reducing their future emissions, and these firms are concentrated among the high emission firms. So it is the high emission firms that generally tend to announce they have target to reduce them, and only 11% of the banks commit to prefer to lend to green firms because they sign this SBTi letter. The monetary policy shock in the period of interest is on average positive. As you can see, it's 1% because interest rates were on average increased during the sample period. This is the period when monetary policy in the euro area, and not only in the euro area, became relatively more restrictive. And as you can see, again, the distribution of the shocks is very much right-skewed. Now, in terms of results, let me first give you some illustrative evidence that already shows that unconditionally firms with low carbon emissions, the green line, pay lower rates or lower premia actually compared to firms with high carbon emissions. The difference is relatively stable, even though it looks as if it becomes tighter towards the later part of the sample, but actually it's quite, it is small, but relatively constant. It's about 14 basis points. And the right-hand side graph shows that firms without emission reduction targets pay a higher interest rate. So also in this sense, the forward-looking variable, we already see accords with intuition. Firms with emission reduction targets, other things being equal, pay relatively less, on average 20 basis points less compared to firms without emission reduction targets. Of course, these are just descriptive statistics. One wants to assess whether these findings also hold up in panel regressions, where we can control for firm characteristics and for bank characteristics, and of course for time variation in these variables. So we in this table you can see that we saturate gradually the specification with fixed effects. The basic specification is only bank and time fixed effects, and then we have bank time and industry, industry and size and location fixed effects, and then eventually we go to specification which has bank time and firm fixed effects. However, despite the difference in these specifications, the basic results stay qualitatively the same, and they are, first of all, that as you can see and as you would expect, banks price credit risk. You can see it here that the PD has a positive and significant coefficient. Firms in the top decile by high PD, they pay a 3 basis points premium, so a tiny but significantly larger, statistically significantly larger basis. A premium is 4% of the standard deviation. In fact, the carbon premium or climate risk premium is, if anything, larger. You can see here the coefficient is positive and significant, and it implies that firms in the top decile by carbon emissions pay a 4 basis points premium, but even more importantly, firms that have a target in terms of future emissions that have committed to reduce their emissions in the future, they pay relatively less. And this is actually, of the three effects, the largest one. It says that there is a 13% reduction relative to the standard deviation of these premia for firms committed to reduce emissions. So it is a 10 basis points discount. Interestingly, also, we find that the interaction between carbon and target is negative, meaning that the high emission firms that announce a target are those that actually benefit relatively more than the target compared to the average effect. So essentially, if you are a firm that has a high emission and you announce a target, this has a very large impact on the interest rates that you pay. Now, one possible concern is that the PD could, in principle, already incorporate climate risk consideration. So why do we find that the PD actually does not fully control for climate risk? Well, one possible answer to this is that climate risk tends to materialize on a longer horizon than standard credit risk. The typical standard credit risk, which is measured and priced in internal credit risk models, is on a 1 year or maximum 2 years horizon. Banks, moreover, banks have no incentive to incorporate climate risk in the PD because this would translate in relatively more regulatory capital. And it could be quite difficult, and in fact, banks say it is quite difficult to incorporate climate risk in internal models. So this, at a theoretical level, could explain why the PD does not fully incorporate climate risk. Empirically, we find that there is zero correlation between the PD in our sample and emissions. And this is consistent with the fact that the ECB, in its climate risk guide, says that even though most banks have implemented some sustainability policies, only a small number of them have fully integrated climate risk measurement in their internal models. Now, we also look, as I said, whether banks that are committed to climate price climate risk relatively more. And we find, indeed, if you look at this specification where we add these three interactions with the commitment variable, we find that banks that are committed price relatively less the PD, so the credit risk, and relatively more carbon risk. And even more importantly, they give a greater weight to the announcement of a climate target by, of an emission target by their borrowers. Finally, let me turn to the second question, which is the monetary policy question. We here present panel estimates where in the first regression, just as a sanity check, we regress these interest rate premia on the PD, the monetary policy shocks intervening in our sample, and the interaction between monetary policy shocks and the PD. And this is already telling us two things. First of all, that thank goodness, the monetary policy shock, since it is a restrictive monetary, it's an unexpected increase in monetary policy in interest rates, is associated with an increase in premia. And this increase in premia is actually relatively larger for riskier firms. So this is already evidence in favor of the risk-taking view of monetary policy. And when we interact monetary policy not only with credit risk, but also with our measure of climate risk, that is carbon emissions, we find that restrictive monetary policy shocks affect relatively more the high emission firms, and relatively less firms that have announced a reduction in emissions in the future. Okay, notice that here we can no longer measure the direct impact of monetary policy shock on interest rates because we are including a time fixed effect, and therefore this absorbs completely the direct impact of monetary policy on interest rates. Okay, and the results also survive when we introduce ILS fixed effect, which supposedly should control for demand side shocks to credit. Now, what about quantities? Now, when we think of quantities, we have to take into account the fact that quantities, that is loan sizes, tend to react relatively less, more slowly to monetary policy shocks, for two reasons. First, because banks may take time to adjust lending policies to changes in monetary policy, but also firms may take time to adjust their investment, hiring, and production decisions to the availability of more or less loans. And therefore, we need to take into account the dynamics, the potentially gradual response of quantities and prices too. And we do this by estimating local projection regressions to capture these dynamic effects. So we regress an outcome variable, which can be either the interest rate premia that we have already used in our panel regressions, or the loan amounts we measure the response to the monetary policy shocks and also to interactions of the monetary policy shocks, both with carbon emissions and the target dummy, so as to capture the potentially gradual adjustment of loan premia and quantities to monetary policy. And these are the results shown graphically. We find that here we show local projection coefficient estimates at month 0, so on impact, which is comparable to the findings that we have in the panel regression at 3 months, 6 months, 9 months, and 12 months. So after 1 year after the monetary policy shock, and we can see in the first diagram on the left that the impact of the monetary policy shock on the lending spread is not only positive on impact, but it actually becomes larger as time goes. So that's the direct impact on the interest rate premia charged to banks. But more importantly, we find that the interaction between the monetary policy shock and carbon emissions is positive, although not very large. And it is positive both on impact and in the longer run after 1 year. The strongest interaction effect, however, comes from the interaction between the monetary policy shock and the target. We see that other things being equal, there is a mitigation effect, which is of 5 basis points for committed firms. That becomes 9 basis points less after 12 months for firms that have announced a target emission. Even more interestingly, we find that the response of quantities is 0 in the very short upon impact. The contemporaneous effect, as you can see in practically all of this graph, is not statistically significant from 0, but actually builds up gradually So there is a 25% surprise tightening leads to a gradual drop in lending, which after 12 months is a 2.7% reduction in lending, so a sizable reduction. Also, the interaction with carbon emissions is significant only after 1 year. There is an additional 2.7% drop in lending for high emitters after 12 months, so essentially a doubling of the overall effect. And here there is a countervailing effect for committed firms. There is a 1.5% mitigation effect after 12 months for committed firms. So overall speaking, both results about interest rates and quantities are consistent with our results regarding from panel regressions regarding the impact effect on premia. Let me just conclude very quickly with another piece of evidence which is not drawn from the data that I've described so far, but is drawn from a survey. As you probably know, every year, actually, if I'm correct, every 6 months, the ECB runs a bank lending survey. So essentially, it's a questionnaire to banks where they ask banks how they have reacted to monetary policy. Mainly, that's the main. It's a way to like keep the pulse of investigate how banks are responding to monetary policy. And we are lucky enough that in July 2023, which is exactly at the end of our estimation sample, the ECB asked in this survey whether in the previous year banks had changed their lending policies differently for brown, green, and intermediate, so to speak, in transition firms, and also asked whether this response, these changes in conditions had been different depending on whether firms in each of these 3 buckets had declared to be committed or not committed to reducing emissions in the future. And as you can see, the left-hand side graph says that notice that this questionnaire was actually done immediately after a restrictive monetary policy period. And here in this top left graph, we see that banks were responding that they had tightened terms and conditions, so essentially interest rates, relatively more for brown firms than for green firms. Actually, if anything, for green firms, they had comparatively reduced them, and with the firms in transition sitting in the middle. And the same applies to credit standards, which essentially refers to quantities, essentially the availability of credit, rather than prices, which are more measured by terms and conditions. Moreover, if you look at the 2 right-hand side graphs, the survey says that banks were actually reducing interest rates relatively more to green firms that had declared to be committed to reducing their emissions, and also to even more so to firms in transition that had made that commitment, and the same applies to credit standards. So, I mean, we felt, somehow comforted by the results of this survey, because they seem to square almost 1 for 1 with the results of our estimation. Let me conclude since time is up. So overall, what do we find in this paper? First, that at least in the euro area, banks seem to price climate risk by charging higher rates to firms that emit more CO2, and lower rates to firms that commit to reduce reduce future CO2 emissions. Next, we find that the bank's commitment matters in the sense that the banks that say that they are committed, that they have signed that, that letter by which they say that they care about the environment, they want to decarbonize the environment. Committed banks provide cheaper loans to firms that commit to decarbonization and penalize relatively more polluting firms. And finally, and this is probably the most novel result in the paper, climate risk-taking channel of monetary policy seems to be at work in the sense that contractionary monetary policy shocks are leading to higher premia being charged on high emission firms and lower volumes of lending to these firms. And there is a mitigating effect for firms that are also, in this respect, firms that are committed to decarbonization. So the bottom line is that it looks as if restrictive monetary policy, at least in the interval of time of our estimation, has increased the cost to all firms, but more so to brown firms than to green firms. So comparatively speaking, it has penalized, if you wish, relatively less investment to decarbonize the economy than general investment in the economy. And let me stop here. Thank you.
Thank you very much, Professor Pagano, for this great presentation and for showing these compelling results. This is an exciting topic, as evidenced by the quantity of questions we already have in the queue. So I'll try to do justice to most of them by focusing on some. I noticed that you might have already answered some during the presentation, so let me start with two that are relatively similar. The first one is, how should bank charge climate risk intrinsically showing up in the long term on short-term loans? And somewhat related is, why do banks charge a higher rate for the carbon emission part? Banks do not disproportionately bear the risk. Everyone is affected by carbon emission.
Sorry, I'm not sure I got the question 100%. So it is about the maturity of the loans, or it is about why they charge higher interest rate to carbon emitters?
Yeah. There are basically two. So let me start with the first one. How should bank charge climate risk, which intrinsically shows up in the long term, if the loans are short term?
Okay. Of course, our loan is measure are not only short-term loans. I mean, many of these loans are longer, longer maturity loans. But this is an interesting point. It's a point that we're planning to address, somehow to decompose our measure by, for instance, taking out short-term loans or credit lines and only focusing on term loans, especially long-term loans. To some extent, you may imagine that even relatively short-term loans could be affected by climate risk, because when firms are potentially, if you think about what happened recently in Europe, the carbon prices have been increasing very steeply recently, and therefore, even in the short term, firms that have a lot of emissions may be quite severely affected by transition risk in particular. So not necessarily all of climate risk materializes, say, in 10 years' time, because here we're talking mainly about transition risk, and transition risk can materialize also in the very short run.
Thank you. The next one is, how robust are the models used by banks to assess climate risk, given the paper's assertion that they may fail to capture tail risk events like regulatory or technological changes?
Absolutely right. I do agree. In fact, even the ECB agrees with that. And that's precisely the reason why banks may use ways which are outside of their, they are not systematically contained in their credit risk models to assess climate risk. Right now, banks are like walking in a kind of no man's land on that front because these risks are difficult to measure in a kind of systematic and consistent way with their credit models. And so banks are calling in alternative measures which are outside of their models. And one of the things that the ECB is doing, for instance, is to keep track of the various rather creative ways in which banks, some banks at least, are trying to do this. But that also tells you why we find an effect which is over and above the PD, because the PD really cannot capture, or maybe it captures, but to a minimal extent, this climate risk, because banks are finding other ways to try and assess it, which is outside of the PD.
Thank you. We have two similar questions related to the data itself. Basically, how did your data sample differentiate between firms with low and high carbon emission?
Well, as I said, we measure carbon emissions as emission intensity. So essentially, we know we have this yearly data that tell us, how much carbon these firms had produced, both Scope 1 and Scope 2 emissions. And we have another variable that is telling us whether firms are planning to reduce or not these emissions in the future. In principle, the data, the definitive data, contain finer information regarding firms' plan to reduce emissions, because some firms specify the extent to which they're planning to reduce emissions and the horizon over which they are planning to do that. But this information is very unsystematic. It differs a lot from firm to firm, and therefore it's difficult to translate this in incomparable information across firms. So we went for a kind of simple, to some extent, simple-minded way of measuring firms' intention to reduce emissions, simply 0-1. A firm has said that they want to do something about it, or they haven't said anything. So that's our kind of rough way of measuring, firms' plans.
Thank you. The results in the first column, I guess the question refers to the slide 13.
Yeah.
So the results in the first column suggest that if firms have targets, then lending banks do not care about probability of default. This is because the interest rate cost reduction is larger than the other point estimates put together. Is this right, or have I missed something here?
Let me see. I have to find this. Okay. Essentially, what if here we are referring to slide 13. What the estimates seem to say is that in our sample, the carbon premium charged by banks is of the same order of magnitude as the credit risk premium, because the credit risk premium is 3 basis points for firms in the top decile by credit risk, whereas the climate risk premium is 4 basis points for firms in the top decile by emissions. So they are roughly similar. I mean, 3 basis points or 4 basis points. The effect which is actually the largest is the discount which is given to firms that are planning to reduce emissions, which is 10 basis points. So it's practically three times as large. Then if actually this person was referring to the following table, which is on slide 15, where we include also commitment. There, what we find is that a commitment by banks is that banks that are committed to climate risk reduction, they seem to price relatively less credit risk and relatively more climate risk. So that is what the estimate seems to suggest.
Thank you. The next one, noting that loan spreads are decomposable into an expected default loss premium and an expected return premium, is an alternative interpretation of the fact that the PD does not encompass the climate risk, that PD captures only firm-specific default risk, while climate risk has a systematic price component. That is, if climate risk is not significant in loan spreads, banks would be mispricing loans by underestimating an important systemic risk.
That's a pretty complex question. I mean, I do agree that on a kind of a priori basis, the PD probably is much more idiosyncratic to a specific firm than carbon risk, than climate risk. If anything, because to the extent that we are really measuring transition risk, say, risk that comes from a sudden unexpected increase in carbon prices will affect practically all the firms that high ematters, especially those that are high emitters. So it is in its almost by definition much more of an aggregate shock than credit risk. Of course, if you have a big recession or a financial crisis, also the PD will probably jump also that has a systematic component across firms. So, but we did not have a financial crisis during the period, so I don't think the PD is actually very correlated across companies.
Right. Is there a way to know whether climate risk proxies for credit risk left out from the internal PD models, for example, by looking at ex-post default rates?
I mean, in principle, yes, but the time period is so short that, and they would have very few observations on defaults for these firms. In principle, if we had a sufficiently long time series, that would be an interesting way to go. But of course, you would also need to assess how much of those exposed defaults have been anticipated by banks ex ante. So I think that other things being equal, maybe using an ex ante variable from the viewpoint of these same banks, such as the PD, is a more logical route.
Thanks. According to the adaptation of credit policies and strategies by banks to align with green monetary policy and address new challenges related to climate risks, is it possible for them to better value the net returns tied to green investments? If so, how can central banks incorporate this into the monetary policy tools they use?
That's a $1 million question or €1 million question. Well, I mean, in a way, our paper makes a small contribution in this direction because it tells something a little bit comforting to central banks. That is that if they tighten monetary policy, even though this will slow down investment for all firms, it is relatively less damaging for green firms, and therefore it is not as damaging to the green transition as one may have expected. I mean, if we had found the opposite, it would have been like saying, the ECB should be super cautious about raising interest rates because on top of the fact that it slows down the economy, it really hammers on firms' plans to make the transition. Instead, we found that the damage to those firms is relatively less. Having said that, I don't know whether this actually should make the ECB very aggressive in its monetary policy tightening, but at least it, let's say, reduces the concerns. Based on this evidence, you would say that the concerns that one may have otherwise had regarding restrictive monetary policy are less than they would have been. So, I mean, notice that Isabel Schnabel, for instance, before we wrote this paper, actually voiced, even though she's clearly a hawk in monetary policy in the euro area, she voiced the concern that actually restrictive monetary policy could have a very strong negative impact on these companies. We find that it probably did have a negative effect, but not as strong as for brown firms. That's
Thank you. We really have plenty of questions, but I will just ask one more, and then we maybe should wrap up. Do the banks have a portion of their funds reserved for lending to green firms?
That I don't know. That I don't know. That would be a good question to ask banks with a questionnaire. Actually, there is to some material if this person who is asking this question is interested in this in these guidelines that I mentioned. There is an official document by the ECB, which is based on a lot of communication between banks and the ECB. So there may be something there, but not as far as I know. I would be surprised if they had a quantitative minimum amount for green firms. But it could be.
Thank you.
I simply don't know.
Thank you. Thank you so much for the thorough answers. Cesario, will you take over?
Yes, thank you. Thank you, Professor Pagano, for the excellent seminar and for taking your time to be with us. On behalf of FEBRN and all these universities that together organize these seminars with FMA International, we thank you very much. Our 200 attendees, a magnificent number of people around the world interested in the topic, and above all in your expertise in the topic. So we are very pleased to have you here today. I think that Miloš tried his best, but maybe was able just to pass 20% or 15% of the questions. We'll share the remaining ones and the comments with you at the end of the seminar, so you can have a full record of the questions. Once again, thank you very much for your time of being with us.
Thank you to you, and thanks for both the questions and the remarks, because we are at the stage precisely of revising this paper, so they come in really timely and handy.
Thank you. Okay, thank you. Have a nice day. Thank you.
Thank you.
Bye. You too.
Thank you.
Bye.
Bye.